Hey guys, good afternoon. Trust you are doing great. So, if you're watching me this afternoon, I would like you to just click the comment section and type your name and let me know where you're watching me from. Today, it's going to be an amazing day because I'm going to be showing you my thoughts about the dollar and foreign currency and where I see the dollar trading into, especially in this season of global tension where we are seeing a lot of missile strikes between the United States, Israel, and Iran, and how that is going to affect the financial market and the things that you should be looking out for during this season. So I'm encouraging you to pay attention on what we're going to be discussing this morning. Just type your name and let me know where you're watching me from. My name is Bala Francis and I'm your favorite smart money trader. Okay, so make sure you do that. Just type your name and where you're watching me from. I would like to see where you are watching me from in the comment section. So while we're doing that, and from in the comment section while we're doing that. All right, so I'm going to start today with taking a look at the dollar index. The dollar index, because the dollar index is the benchmark asset for the dollar and dollar associated currency. I said that the dollar index is the benchmark asset for the dollar and the dollar associated currency. So that makes it important that you always start your analysis with the dollar index because it's the main driver for the dollar and foreign currency. What that literally means is that the dollar being the benchmark asset becomes the main driver for foreign currency. That means if the dollar is rallying bullish, we expect to see a reaction on foreign currency to rally bearish because the dollar is rallying. But you are not looking at the foreign currency yet until the dollar shows you smart money signature to rally, then you start to short foreign currency. If the dollar index is not ready to rally, even if this guy is showing you signature to start selling, you have no business executing on the foreign currency because you will be misled and they're going to use you as liquidity. Take out your stops. When the dollar finally gets ready to rally, then they start to drop. Okay, so that's why I always emphasize that start with the dollar being the benchmark asset. And every single week when I start up doing my analysis, I like to go to the economic calendar forexfactory.com, and I would like to start the week by simply looking at the calendar of events, and I'm taking note of 3 deadly news events that you don't have to trade, especially if you're a beginner trader. FOMC is the non-farm payroll news that reflects the unemployment change in the United States. And this news event comes up every first Friday of every month. So put that in your journal that the first Friday of every month is non-farm payroll news event, and you do not have to trade because during that type of news event, the speed in price delivery that it injects into the market has the potential to liquidate your trading account faster than you can ever imagine, especially if you are wrong. And even if you are right, sometimes during the news, brokers will open up their spread and it's going to hit up your stop loss before moving in the direction that you projected that price was going to trade into. So in my opinion, you do not have to trade the NFP, and I always recommend that during the NFP week, after the Wednesday of the NFP week, you just have to stay on the sidelines. You do not have to engage during NFP week. Then number 2, the news event that I think you should always look to avoid is the CPI. The CPI and the FOMC. Most times FOMC comes out during a closed session. Most times it's evening hours when the London and New York session has closed. That's when FOMC comes out. So you have no business even trading outside your trading kill zone time. Okay, because smart money trading is basically about confluencing time and price. If the time is not ready yet, you have no business looking for price action signature. All right, so these are the things that you should be avoiding. So when you go through your calendar every Sunday in preparation for the week, you are taking note of 3 things: the high, medium, or low impact news events. The low impact are signified with the yellow boxes. A day or week where you see there are no high or medium impact news events will signify a quiet trading week. Okay, so when you scroll, you can see that today being Monday, 2nd of March 2026, we have high impact on the dollar by 4 p.m. and a medium impact on the euro by 3 p.m. All of these are happening during the New York session. For me, since I'm trading the dollar, so the associated currency, the foreign currency, I'm going to be focusing on those two. So it gives me confidence that there's going to be liquidity injected in the markets today. So you go through Tuesday, Wednesday, Thursday, you take note of the news event, the impact expected. When you put up your cursor, you'll see that the yellow represents low impact, the red represents high impact, the orange represents medium impact. Then the currency asset, the impact is going to happen on, and the time is very important, and the date that the event is going to happen. Then you can see that on Friday, 6th of March being first Friday of the month of March, we have non-farm employment change coming up on Friday 2 p.m., which is the non-farm payroll news event. You do not have to trade this. Some of you can create a demo account just to experience what the market does during those type of news events. So you can have, practical experience about what I'm talking about. Then once you do that, you go to your trading view and you start up your week with the monthly time frame on the dollar index, because the monthly time frame is the higher time frame. It's an institutional time frame. There are 3 time frames you should be doing your top-down analysis: the monthly, the weekly, and the daily time frame. That is where institutions are focused on positioning their orders, and so you need to be in alignment with the order flow. The order flow is seen on the higher time frames, the monthly, the weekly, and the daily time frame. So once you do that, then you go down to the weekly and the daily time frame. On the weekly time frame, you are studying price expansions and retracement into internal range, fair values, or order blocks. On the daily time frame, you are looking at the market structure that is in line with the current order flow. Those are the things you would be focusing on the daily time frame. So looking at this current month, the monthly time frame, you can see here, what I see here is, I see that because I did notice a lot of retail are going to be manipulated, especially because of the Iran and the US crisis. A lot of people are ignoring the dollar, the direction of the dollar, the order flow. They just want to sell the dollar and buy gold because they think the dollar is going to go short. But that's not the case. What I see here, yesterday night, I was having a chat with one of my students, and I told her that I don't see the dollar selling. What I see here, from what I know and I understand about smart money trading, is that the dollar is bullish. Why did I say that? When you look at this price action, price is currently in a discount bullish order block by the left here. That bullish order block Let's outline that for you. You see that guy, price tapped into it severally, consolidated for a while, and finally we've seen price taking our liquidity below that low there, and is showing symptoms to rally. The rejection that closed that candle above that low already is a pin bar confirmation that this is going to rally into the next draw liquidity, and it's going to be the relative equal high, and the sell side imbalance, buy side inefficiency residing above right here. That liquidity void is where I'm looking at as the draw on liquidity. Okay, so we go down to the weekly time frame, and on the weekly time frame, what exactly are we looking at? What are we looking at on the weekly time frame? We're looking at price action creating expansion signatures or reversal patterns in line with the monthly order flow. Since we're anticipating bullish price action on the monthly, you can see that on the weekly time frame, price took out that sell side liquidity pool by the left and created that rejection block. You guys remember what I taught about rejection blocks here? That a valid rejection block only happens when price sweeps liquidity and creates either a swing low or a swing high. That is when you have a valid rejection block. And exactly what happened? Price taking out that sell side liquidity and creating that 3 candle price action, with the middle candle having the lowest low, that swing low. You can see how price tapped into the rejection block and starts to rally on the weekly time frame. So I already know that we're bullish on the dollar, and if we're bullish on the dollar, where are we targeting? We're targeting the next draw liquidity. It's going to be the sell side liquidity pool there. You can see that relative equal highs there. All of that, I just decided to mark. You see that high and the fair value gap residing above that guy. It's going to be potential draw on liquidity for the dollar to rally. Okay, now these are rare setups you're going to see, because most of you are going to be focusing only on structure, but behind the structure, the narrative is bigger than market structure. Okay, so this week I already forecasted that we need to see price open and starts to rally, and we're already anticipating that the dollar was going to open with a gap open higher because of the crisis that we've seen, the global tension that happened over the weekend. So I was already expecting that it's going to be a gap open, but in the direction of the order flow, and specifically we saw other confirmatory signatures to support our idea. So on the daily time frame, remember we're studying market structure. You can see price took out that external range, sell side liquidity pool. Everything here was the narrative when we were selling. We've taken it out, and that's what is more important. This is smart money reversal. So price traded into that weekly rejection block. But right in there at the weekly rejection block is also a daily fair value gap. It's also a daily fair value gap. There's something you need to understand about price retracement. When price is retracing, it is retracing into fair value gaps or other blocks. Okay, so right in there you have another block, the sell candle that was engulfed by the consecutive buy candles, and right there with a fair value gap, the most valid order block is the one also that has a fair value gap attached to it. Price traded into it and created another expansion. After that expansion, again price traded into, you can see that fair value gap right there, that internal range fair value gap. Price also again traded into that level. All right, you can see the body of the candles respecting the fair value gap, and right there we had a swing low created. Okay, so for me, even right here on the daily time frame, I saw also another simple pattern. You can see price action taking out that relative equal low here and creating the rejection block, the middle candle having the lowest low, You can see subsequent candles traded into that rejection candle right there and created another swing low to rally. So I already knew that we were going to continue into the drawn liquidity, and for me the drawn liquidity, as you can see, like we have outlined already on the weekly, is the relative equal high, but on the daily time frame you're going to keep re-outlining them at different levels, because price is algorithmic. For every expansion that takes out external range, price will reprice into the internal range to reaccumulate contracts to still move further. So that's what price will keep doing. So these were targets I already outlined, that the bearish order block price will trade in there, would show some reaction before it moves to the next stage of distribution. On the 1 hour yesterday night, let me show you the setup I saw yesterday night on the 1 hour. So I studied the 1 hour time frame yesterday night, and what I saw was that price action actually created a bullish flag. What is a bullish flag? When price action creates expansion and starts to, consolidate and retrace and consolidate, you can see this technically looks like a flag, so it is called a bullish flag. All right, but right within the bullish flag, you can see that price action has been creating higher low. You can see that higher low, showing you bullish momentum to continue higher, and this will serve as the relative drawn liquidity, the relative how to identify powerful order blocks. And one of the rules I identified bullish, so that was a mitigation block. Price returned into the mitigation block there and created a bullish order block. Okay, and created a bullish order block. Price created a bullish order block after trading into that mitigation block right there. Let me remove all of those. Okay, so that bullish order block, you can see, engineered some expansion, and price traded back into it on Friday. So I was telling one of my students yesterday night, I said, you see this bullish order block, it's going to hold price to rally massively into the draw on liquidity. And exactly what happened. So price opened during the midnight. We saw price open with a gap open higher, very massive gap. Are we just going to continue buying? Nope, we're not going to be buying right there. We're going to be waiting until we see price retrace into the internal range. You see that? You see that gap opening? So right in there, you also have the breaker, because price had taken out the low, price had broken structure higher, and right there you have your midnight opening gap. So price returned into it. That could have been an entry execution for you, except that the timing does not agree with the trade setup. This happening at midnight, so you'll not be able to have taken a trade right there. Then we had another expansion, and so again price has retraced into, you can see that fair value gap. Remember what we mentioned? We said every expansion, price will love to reprice into fair value gaps. Okay, price has retraced into this fair value gap right now during New York session. So what am I going to be doing? I'm going to be waiting for confirmation. What is that confirmation? Bullish order block to be created. Once this candle closes as bullish, we have a bullish order block here. So I want to see price tap into the order block, and I'm going to take more longs on the dollar. While we are buying the dollar, we just go and sell Euro USD, GBP USD, everything foreign currency. You can go short. You can short those foreign currencies, and while you're shorting those foreign currencies, the dollar is rallying. But you can see how we systematically did it from the monthly, the weekly, the daily, and until the dollar is ready to rally, we have no business selling foreign currency. I mean the Euro USD. Okay, then let's look at gold. Gold, we already knew gold was gonna rally very bullish, and that was the draw on liquidity for me on gold right there yesterday night. We already outlined that guy as the potential draw on liquidity right there, but I'm still bullish on gold. I want to see gold rally into that that buy side liquidity pool right there, even though right in there we have a rejection block, so we might see some rejection, some repricing or retracement before it rallies again. But overall, gold is still bullish, and one reason you should be buying gold, so you can see right now that correlation between the dollar and gold is not correct, it's not positive, because on a normal day the dollar is rallying, gold should sell. But what is driving gold right now is market sentiment. All right, market sentiment, because the dollar right now is no longer a safe haven asset. The dollar is in a risk-on environment. Investors will be scared of keeping their money in the dollar, so they would like to mitigate risks by removing money from the dollar and pushing it into more stable assets like gold, your precious metals. Those are assets that they are going to put in their money to manage risks. So that's why gold is going to keep buying as long as US is in a crisis or US is in a war with another country. How you know that the dollar is in a risk-on environment is just identify global tension, crisis, war, all of those things makes the dollar go into a risk-on environment. Okay, the dollar on a normal day is supposed to be a safe haven asset because it's the most stable currency in the entire world. But once the US is in a war with any other country, the dollar ceases to become a safe haven asset. Investors are going to get afraid. They're going to get scared of. We're bullish on gold bullish, right? We're bullish on gold. So on 1 hour time frame, we just keep looking for. So we actually took this trade this morning. Yesterday, one of my students, let me show you guys. She had a trade from last week, and we had to talk about that trade. You know, from last week, she had a trade from last week, and we had to talk about the trade. We had to talk about the trade because it was really doing so well. Okay, you can see, because my students give me feedback every single time. She said, I took courage and I deposited $540 around January. I bounced back and forth, and now we are at $3,800. I said, awesome, let's get to 10K. Right? Let's get to 10K. That's what a mentor does to you. It pushes you to even see beyond your capacity, beyond what you are seeing. You are leveraging on somebody's capacity to get to where you want to. Just a few moments later, I think about that same day from 3008, after we had a conversation, I gave her things to look out. There's a bearish order block on H1, fair value gap of 15 minutes, switch for retracement move, but anyways, follow your plan. She took the trade. She said, I took all profit of account bump to 6K. I said, awesome. You can reposition during the New York session. The buy is massive. All right, so we took a look at silver, blah, 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 blah. Again, last week, Tuesday, you can see total equity is how much? I was asking her. She said $24,000 to $25,000. I said, okay, amazing. Do move stop loss. I said, yes, do that. Okay, but fast forward to yesterday night. So yesterday night, fast forward to yesterday night, take a look at it. So yesterday night, when the market opened, so I told her that, okay, the gold has opened and we're really bullish as expected because we had a trade on that gold. She said, we are flying. I said, okay, close it ASAP. Take what the market gives you. This is a powerful lesson I need all of you to learn. Sometimes you don't always have to insist on what you want to take from the market. Sometimes you should learn to be contented as a trader to take what the market gives you and compound equity, and that makes your growth very easy. You started with $500, now your account is about $20,000, or you are seeing profit, your account is about $25,000. It is strategic for you to close profit. You are no longer starting at $500, you are starting at $20,000, and it's easier for you to get to $100,000 from a $20,000 than it is to get from a $500. So why do I need to? Any profit that you have not closed does not belong to you, belongs to the market. Let me say it again. Any profit that you have not yet closed does not belong to you. It belongs to the market. Okay? It belongs to the market. Any profit that you have not yet closed does not belong to you. It belongs to Okay, it doesn't belong to you, it belongs to the market. Okay, so that was why I didn't even know that. Give me a minute, guys. I think I need to show you guys something. Yeah, just give me a second. That you have not yet closed. Please, if you can hear me, just type in the comment section. Let me know that you can hear me. Let me know that you can hear me. Okay, so that was how we were able to do all of that within a very short period of time. The goal, like I mentioned, is that find a way to strategically compound equity rather than keeping everything and leaving it to the market. Any profit that you have not yet closed does not belong to you, it belongs to the market. All right, so right now account is at $30,000 by simply compounding profit rather than letting it run to 100K. That's not the goal. The goal is to gradually get to 100K. All right, it's to gradually track your growth gradually. Nobody is chasing you. The market is not going to run. The market is there. The market will always be there. The market will continue to create opportunities for you to make a lot of money. Okay, the market will continue to create opportunities for you to make a lot of money, but how you now position yourself to make all of that money is dependent on your ability to learn what we call the skill of compounding. It is called Compound Effect. There's a book by Darren Hardy I recommend most traders. It's a must-read book, especially if you're a trader. Right, so if you're a trader, make sure you get that book. Read that book by Darren Hardy. It talks about compound effect, how to compound equity gradually till you get to where you want to be as a trader. Okay, so I really hope that you learned something in today's commentary. The summary is we are bullish on the dollar. We are bullish on the dollar. We are bullish on gold, and we are bearish on foreign currency. Okay, we're bearish on foreign currency. I hope you learned something. If you do, please do well to let me know in the comment section, and feel free to reach out to my DM. Just check the link on the description of the video. And until next time, I wish you guys good luck, good trading. Stay safe.